Now that we've had those rundowns, we're going to the first guest of the Pulse on this session. And second quarter earnings season is upon us, with major banks in the US about to start reporting on Friday. In light of this, Peter McGuire from XM joins me now to delve into market directions as we head into the reporting season. Good afternoon, Peter.
Good afternoon, Danielle. Lovely to join you.
Fantastic. Looking very smart as always. So, we do have those banks reporting this Friday, and we've also had incredibly strong markets in the US. So are we going into a moment of truth potentially for these US markets with this reporting season?
Well, I think, Danielle, you've got to look at a couple of key points. First off, naturally, the S&P 500, I'm just looking at some points, 19 times earnings for the next 12 months. So there's that first side of it. The Nasdaq's running at around about 27 times earnings for the next 12 months. So are they going to be justified as far as performance? What are the earnings going to discover? What are we going to discover? And we appreciate the S&P 500, about 40% of their revenue is from overseas. And the Nasdaq, it's even worse. It's 60% of their revenue is derived from overseas. So that's outside of America. So if they've got a weakness in the Eurozone or China or consumption across the globe, which seems to be pretty much the patter, then it'll be interesting how this next half looks compared to the first half.
Yeah, absolutely. I have noticed that really the earnings forecast for the US, and we might have a look at the tech rally with that chart as well, that the earnings seem to be picking up towards the latter part of the year. So it really will be a telling time in terms of margins and things. But this tech rally, very much AI driven. And I know you've got an interesting chart here, because at the moment the general treasury account, I think it is the TGA or the general account, they're refilling their coffers and issuing, the US Treasury issuing a lot of bonds. So are we seeing potentially a liquidity dry up that's going to impact on this tech rally?
Well, you know as well as I do, I mean, you need liquidity. And this is the great concern that many people are saying. And I listen to many analysts and hedge fund gurus from all over the world. I just plug in and I listen to stuff. And everyone's worried about how we're going to be in the next three or so months from a liquidity standpoint. So I don't necessarily have a view on it, because I just want to see, I think we're a little bit too close to, when I say too close, I need to get closer to the fire to appreciate how bad it's going to be, Danielle. And I'm not suggesting it's going to be bad, but at the moment, I'm just sitting here observing, appreciating, and don't let's forget that it's been absolutely jet fuel rally for the first 6 months, and it's hard to get in the way of a bull market. So, I just need, are we going to see a consolidation phase, and how all of that's going to materialize in the next couple of months? I just need to sit here and inhale and wait and see how it all rolls.
Absolutely. And we've also got that great valuations charts. You've already mentioned the numbers, but let's just have a look at that chart there, because that's also quite telling, isn't it, within a historical context?
Well, exactly right. I mean, you've got to be mindful, on the S&P 500, when you're running at 19 times earnings for the next 12 months, forward earnings, that is, it's not the past earnings, it's the forward. And we need to be very conscious that when you look at those numbers and you appreciate it, very, very few bull markets commence at 19 times earnings. Historically, they're very, very expensive. So we've just got to see where all of this again rolls over the next couple of months. Maybe we're going to see a breather. Maybe we're going to see a continued uplift. The AI story certainly isn't dead, and we've just got to see the impact as far as raising rates and that whole philosophy, how that's going to impact the next 6 months or so, Danielle.
Absolutely. And maybe let's have a look at the S&P daily chart. Because, yes, absolutely. Because what are you seeing here, Pete?
Well, I'm seeing it's off to the races.
Indeed.
It's been absolutely outstanding, and that's the bull market. That really gave us, that when we saw that big pullback going, put your mind back to October, November, December. That was really a wake-up call, and many traders thought, well, are we going to see a continued downdraft? And you saw a big pullback as far as the Nasdaq, and then you had that Christmas sort of, all right, get out of the way, and then January started, and it was off to the races. And it's had that. We went through March, and we understand the banking crises in America, and that more or less everyone was a little bit, scratching their heads. How bad's this going to play? And then since then, it's been onward and upward since the tail end of March, early April, and here we are in mid-July, and it's looking relatively rosy. So, don't get in the way of a bull market at the moment, Danielle.
Yeah, indeed. Just as a slight aside, Tom Lee from Fundstrat over in the US, who is a perma bear, you might have heard him talking on CNBC. Yeah, sure. He's just called effectively a tactical move that the S&P could rally another 100 points post this upcoming Wednesday CPI. So it's just worth putting it out there that he was brave enough to actually say that. And I think he's got a target of around 4825, 4850 on the S&P. So we'll have to wait and see, but a very brave man nevertheless. Let's have a look at the Bank of Canada, because really Canada has been at the forefront of tackling inflation, and they've been at the front end of moving rates higher. So this chart seems to suggest that we are seeing quite a nice movement downwards in the Canadian CPI.
Well, yes, we are. It's certainly pulled back, and it's pulled back quite nicely. If you're looking as far as a rate hike perspective, you're thinking it's going to be around about that 70% chance of probability of a rate increase, 30% for no action. So that's where the Bank of Canada is situated. As far as the pullback, that's a good sign for consumption. We've got relatively cheap energy prices. Food's still frightfully expensive, but from the big drivers as far as energy, we've got a high degree of respite, because you're still languishing at $70 a barrel, 75. And that gives the consumer much more breathing space from the wallet and the purse when they go to fill up the car.
Yeah, absolutely. Well, there's a lot on this week. So thank you, Pete, for those charts. I guess we'll all be waiting, won't we, on, some of us will be waiting on Wednesday evening and some of us won't be.
Yeah, I think so. I mean, we've just got to get a real appreciation, and then, how that falls, and do we see, the 26th of July as the blast off for the Fed, another 25 basis points. That seems to be pretty much baked in, Danielle. So I think it's going to be an exciting week.